Retirement isn't just about leaving work. It's about choosing how you want to live the next chapter of your life. If that idea has crossed your mind, even briefly, you're in the right place. I'm Tony Da Silva, and this is the Aging Agenda Show. This show is for people who know retirement is on the horizon and want to feel confident when it arrives, because retirement isn't a single decision. It's a series of choices that shape your finances, your relationships, and your everyday life. Here on the Aging Agenda, we talk about conversations most people put off while life is busy. Not just when to retire, but how to retire well. We keep it practical, clear, and jargon-free as we explore questions like, why am I thinking about retiring now? What does affording retirement mean? For my lifestyle, how will my decision impact the people I care about? What do I truly want my retirement years to look like? This show is complemented by the Aging Boldfully Show, where we focus on living well and aging with purpose, because a fulfilling retirement often begins just outside your comfort zone. Today, my guest is Arthur Vigeant. Thank you for joining us. Tell us a little bit about yourself.
Well, I'm a CPA, been practicing up in Marlboro now for just over 40 years. Had an office on Main Street that actually I just closed last year when I semi-retired.
So you've joined us, you're retired.
I joined the club.
But you still have some clients.
Yeah, I still working a couple days a week, but I was taking care of a lot of individuals and small corporations, and like I say, had that office there for, geez, I'll bet you that office has been there for 35 years now. So it was a great run while I was there, that's for sure.
Well, let's begin with someone who comes to you and says, I'm about to retire, I've been living off my W-2s.
Yep.
What do I need to do in terms of thinking about moving forward with my taxes?
Well, the thing is, you need some kind of budget to find out what does it actually take for you to live on for the next year. Because spending changes when you retire.
Yeah.
Going out to lunch with your colleagues from work every day, and maybe not going to the meetings you were going to before. You don't have to buy these clothes anymore. You can wear the jeans and shorts and T-shirts. So spending changes a little bit. So what do you spend in a year? That's obviously the big thing to keep an eye on. Planning as far as, okay, you have a pension, you have an IRA, you have Social Security coming, or you don't. What do you have for savings already? So trying to figure out what you need to spend, and then you can put it into the categories as far as what kind of taxes you need to worry about in the future.
So my W-2 is going away since I'm not going to be working anymore. My Medicare is going to kick in.
Yep.
I have a defined benefit plan. I have a pension that I'm going to be collecting. So those streams of income, are they going to be taxed differently than it was last year? Because last year most of my income was W-2.
Yeah.
This year or next year it's going to be something else.
Yeah, most of it is going to be taxed as ordinary income except for Social Security. If you receive Social Security, a portion of that may be non-taxable, 15% of it for everybody, but if you're in the lower income brackets, it could be non-taxable or maybe taxed to 50%. So keeping that in mind, but doing a little bit of planning in advance, because the big thing people don't think about is maybe they take an IRA and don't have any withholdings. They have Social Security that doesn't have any withholdings. At the end of the year, they have someone prepare their taxes and make the phone call and say, oh, by the way, you owe $4,000. So make sure you have the withholdings to cover whatever income you have.
That would be bad.
That would be bad.
That would be bad.
Because usually people on the lower end don't necessarily have some extra cash hanging around to pay that tax bill.
Right, and I'm used to paying X percentage every year.
That's right.
So my general thought would be, okay, I'm retiring, I should be paying less.
Yeah.
Right, and if I all of a sudden find out I owe $2,000 or $3,000 or $4,000 more because I didn't plan accordingly or I didn't seek out expert advice to kind of help me, okay.
No, you can have federal withholdings taken from your Social Security, not state.
Okay.
But IRAs, when you withdraw from that, you can have a percentage taken out of that for both federal and state.
Yeah.
So.
And you'd suggest that I do that?
Oh, absolutely. Because although maybe it's good tax planning to owe 10% to the IRS every year,
Yeah.
no one wants to be there. Everyone
Yeah.
wants the refund. So you're giving them the money in advance
Yeah.
so you get it back at the end of the year. But you definitely won't want to owe them if you
Okay.
don't have money available.
Okay. And when you say money available, and the money that I think I'm going to be
Yep.
getting when I retire, I said includes my Social Security and
Yep.
includes, I hadn't even thought about my IRA
Yep.
because that's something I've been putting money into
Yep.
forever. I never thought about actually taking it out. I guess I got to worry about that now. And I'll take it out as I need it,
Yep.
but that's going to count against my total income,
Yep.
and I may or may not have to pay taxes on it depending on how much money I actually make. How about things like a pension plan? I mean,
Yeah.
my company was good to me. They provided me a pension plan. To be honest, I don't know how much I'm going to get until I actually retire, which I've got to notify them. When that money starts coming in, is that taxed or not taxed?
Yeah, it's taxed the same way. Most of it is taxed unless you kicked into it. So again, everything we talk about, there's exceptions to the rule on everything
Oh.
when it comes to the tax code, but it's taxed very similar to your wages, your W-2 wages, except you're not paying Medicare and Social Security taxes on it, but you're paying your federal and state taxes on most. State pensions, there's no state tax, but you do have federal tax.
So I still got to pay federal. Is that true also for like dividends? Because I was told that I should have some stocks to pay dividends to give me an income stream, but dividends get taxed. Even though I'm retired now.
Right. There's a couple different ways of taxing dividends, and whether they're qualified or non-qualified dividends, and whether there's usually in a brokerage account, you have mutual funds. Mutual funds have dividends, interest, and capital gains. So make sure you count that the right way on your tax return. But the capital gains are going to be taxed differently than at a lower rate than the dividends and the interest.
The more you say, the more I really feel like I need some expert help on it.
No, well,
It gets complicated.
Hopefully you have a good tax guy that takes care of you every year. So.
Right, but it sounds complicated.
Yeah.
Speaking of that, one of the things that I live in an over 55 retirement.
Yeah.
Some of the things that my neighbors ask me about are RMDs.
Yeah.
And all of a sudden they were notified they were getting a check, or they got a check and they didn't know what it was for.
Yeah.
How does that play into my income stream? And
Yeah,
do I get that every year?
It's just like your IRA. It's taxed as ordinary income, but it's important to keep track of that because you can't take your IRA in most cases till you're 59 and a half. And today you're required to take your IRA if you're over 73, unless it's a Roth IRA. Then you don't ever have to take it and you can pass it down tax-free to your heirs. But at 73, you have to start taking your IRA account. And it's figured over your life expectancy. So obviously at 73, you have a life expectancy of, say, 20 years. They'll divide it by the 20 years, send you that check every year, make sure you have some withholdings on it, and you're gonna count that as income just like anything else. The problem is some brokerage firms do not follow up with you and say, okay, you turned 73 this year, you need to take your RMD. I've run into that a few times where they come at the end of the year, where's your statement from your IRA? I didn't take my withdrawal this year.
Yeah.
So now there's penalties for not taking it, and you got to double up on it. So make sure when you're 73, you talk to someone that is in charge of your IRA and make sure they withhold taxes on it and get a distribution out of it.
Right. You just triggered two thoughts in my mind. When I had to take my RMD, I was 70, 71.
Yeah.
So the laws must have changed in the last few years?
The last couple of years, yeah, it went from 70 and a half up to 73. So most people now are in the 73 area where they have to start taking it at 73.
And does this law change frequently? I mean, is there a chance it's going to be 75 next year?
Uh-huh.
So, just to keep it simple.
They changed them, and the last couple tax bills have been very complicated because they put in a lot of things that were temporary. Yeah. There's a lot of changes that went in for 3-4 years. In the old days, we used to get one big tax bill, then we wouldn't see another big tax bill for a couple of years. Now they're coming out all the time. when one congressman has a deal that he's working on and wants a tax break, he puts through a tax bill and he gets a tax break, and we don't. You know, so the timing is very funny because a lot of them are at the end of the year. They may be April 15th or October 7th, or you know, so the dates are different. But it's gotten very, very complicated. It was a lot simpler when I was younger.
Yeah. Wow. Yeah, and the other thought that came across my mind is I didn't realize how RMDs were calculated.
Yeah.
It's calculated from this time you have to start taking it on your expected life.
Changes every year.
Right.
So there's a chart they have set up.
Yeah.
In fact, if you still have an IRA when you turn 100, keep this in mind, when you turn 100, you're still going to have an RMD, a life expectancy of about 3 years. So there's
pay.
always a calculation. It changes every year.
Yeah.
And you have to go to that chart. But a lot of the brokerage firms, most of the brokerage firms, if you tell them you want an RMD automatically every year, they'll do it. They'll do the withholdings for you, and there's no issue.
All right. Okay, let's look at the pessimistic side.
Okay.
I only live 2 more years,
Yep.
and they calculated to 80.
Yep.
What happens to that other money, those RMDs I was going to get every year?
If you've already started receiving it,
Yeah.
it's one calculation
Yeah.
for your ears.
Yeah.
If you haven't started receiving yet, it's a different calculation for your ears. And your spouse has a different set of rules than, you know, say your kids. If your kids are the beneficiary, they have one set of rules. Spouses get a separate set of rules.
Okay, so that's something that I got to make sure is in my will or a trust or whatever I've got.
Actually, when you set the IRA up, you set up beneficiaries within the IRA, not through the will or the trust or the estate.
So it should be all taken care of.
All taken care of.
All right.
Just a question of how they're going to have to handle it once they get it.
Well, I'm glad to know that the government's not going to get my money after I die.
No. The only time you run into that really is with Social Security. And, you know, the question always is, do I start collecting at 62 or do I wait until I max out? And you tell me when you're going to pass away, and I'll tell you exactly what to do, you know. But so at 62, you run into a problem until you're 67, because if you work part-time or full-time, you have to pay back some of the Social Security you received.
Assuming you started taking it at 62.
Exactly.
Okay.
So you want to wait till you hit your Social Security age, which now is 67.
Yeah.
So you start taking it, you can go back to work, you can do what you want, still receive all your Social Security and not have to pay anything back.
Oh.
But some people want to get that extra bump in Social Security, so maybe they wait till they're 70 before they start receiving it. Again, if you say, I'm going to wait, and you pass away tomorrow, now you get nothing. Social Security doesn't go to your ears. There is a calculation for a spouse, but you can't pass that down to the kids or someone else. So that's the only one you're kind of gambling with a little bit. But again, you know, if you have a family with a long life expectancy, maybe you do want to wait a little bit. I took mine as soon as I was eligible. You know, as soon as I hit my full retirement, full retirement age, which for me was 66 and a half, I started collecting.
Yeah. I did the same thing.
Yeah.
I waited till I was 66 and a half and I started collecting. But I didn't realize that if you start taking at 62, which I know a lot of financial advisors suggest you do that, and you go back to work, you actually have to give some of that money back.
Yeah, I think it's $1 for every 3, but there's a calculation in there that you use, but you do have to pay some of it back until you hit full retirement age. So you have to watch that. I've actually had some people that wanted to suspend their Social Security or suspend their state pension, and you get into other calculations. So it's really an individual thing, and you should be talking to somebody to figure it out or help you figure it out.
You brought up another point that I've thought about a lot is you expect to live to 90 or 95 or your spouse to live to 95. One of the sales pitches I hear from television and other people is I should buy an annuity because it would guarantee some level of income for whoever lives the longest. How does that affect taxes, or doesn't it?
Annuities are taxed just like other income.
Okay.
Again, adjusted based on the amount that you paid in to buy that annuity. As you know, I'm not an annuity guy.
Yeah.
I'll leave that to the financial people,
Right.
but I don't think annuities work in most cases. They love to sell them, but it's a sales pitch. It's in most cases it doesn't help you out, because once you're in annuity land, you basically stay there, and then you don't pay taxes on an annuity until you start pulling money out. So they use it as a tax deferral. Well, if they're selling in your IRA, you're buying an annuity, you got double tax savings.
Right.
So you're not really protecting that money from taxes, because it's already protected from taxes in the IRA. But again, I'll stay off the annuities, because the financial planners go crazy when I talk about annuities.
But from a retiree's point of view, in the tax point of view, the thing is, if I have an annuity and I'm getting money, it's going to get taxed.
It's going to get taxed.
It's going to get
a
taxed.
percentage of it is going to get taxed. And it works when you're dealing with nursing home and planning for that. That's when the annuities may in fact work
sense.
for you.
Yeah. Okay. So it's just taxed just like any other income that I get after I'm retired.
But if you keep in mind that if you have $500,000, it depends on how much you take out. But if you have $500,000 and you're earning 4% a year on that $500,000, and you take out 5% of that every year, $25,000, you will never run out of money.
Yeah.
It will last 41 years. So unless you live to 120, you're good. So
you never know.
They never know.
No. How about things like home equity loans? Some of the people that I've talked to, they're short on monthly income, and they say, I'm looking at a home equity loan. Does that make sense? Reverse mortgage, does that make sense? And if I do that, what happens in terms of taxes? Do I have to consider any taxes? Because usually I'm considering I don't have enough money. If I do this, is this going to help me on taxes, or is this going to hurt me on my taxes?
Yeah, it's not really going to do too much for you as far as taxes go. Obviously, it's eating into your equity. The equity loans are one thing, because usually it's a smaller amount. The reverse mortgage, you're almost giving up your house. If it's the only equity you have and you need it to live on, again, I'm going to leave it to the financial planners, but it's just, that's the last resort for income. And if you need that to live on, it's an opportunity to use it, but it's an individual case.
But I don't have to worry about paying taxes on whatever I'm getting on that. Okay.
No.
So that's a way to increase my monthly income and not worry about the tax implication at that point.
If you're borrowing money to pay your bills, you shouldn't be worrying about taxes, because my guess is you're not making the income you need to pay taxes. So, but when you start getting into borrowing to pay for living expenses as you get older, it's a difficult situation, because you don't want to be borrowing money. You want the debt to be gone, the credit card debt to be gone. If you have a mortgage, make the mortgage payment. Don't pay the mortgage off if you have one of these low interest rates, 2%, 3%, 4%. You don't want to do that. Pay off everything else. Pay off the credit cards. Pay off the car loan. So you have no other debt except maybe the mortgage. And then if you have some extra money and you want to put down on that, but hopefully, if you have one of the low interest rate mortgages, you don't want to pay that down.
So I should probably try to do all of that prior to my retirement. Get my credit card to zero.
Absolutely. Get rid of it.
Get rid of as much debt as I can before I stop working.
Exactly.
Right. Let's take a look at the other side of the equation. I've got a lot of money. Certainly more than enough to pay all my bills. Some of my neighbors, again, are talking to me about how to avoid taxes, because this is a big topic if you've got money.
It's great. And down at Bart's Bar down the street, they have very good tax advice also.
Yeah, so I get some of that. But one of the things they talk to me about is gifting money to their children or to their grandchildren. And do they have to pay taxes on that? Do I pay taxes on it, or does the recipient pay taxes?
Actually, they can gift up to $19,000 a year per person per year. So you can give the kids $19,000. You can give the grandkids $19,000. Everyone can get a $19,000 check from you every year. If you go over that number, you should be filing a gift tax return. Does that mean you pay taxes on it? No, you're not paying taxes. You're using your estate exemption. So everyone has an estate exemption, and you don't have to file a federal estate return until you hit $15 million. So
I'm not going to worry about that.
no, but a lot of people try to wean down. It's not for the federal, but for the state of Massachusetts, it's $2 million. Well, it was $1 million up until a couple of years ago. Thankfully, the governor and legislature saw it to raise that. But the interesting thing was it used to be $1 million, but if you had $1 million in 10, then you got no exemption. It went all the way back to zero.
The $10 did it to you.
The $10 did it to you.
Wow.
So now it's $2 million and you keep that exemption, but people try to get under that $2 million by gifting out, $19,000 a year. If you do more than that, it just comes off the exemption when you pass away.
And the recipient doesn't have to pay
taxes. No one pays anything. The only thing I recommend is a little thank you letter or a little something. So
from the recipient.
Well, just to say that if they do have an audit, they had a big windfall in their bank account, and the IRS says, where'd that income come from? Well, it wasn't income, it was a gift from my parents. Says who? So
right. Okay, I see.
Sometimes they dig in the weeds, but not usually, but I always suggest doing some kind of little note between you.
Right. So again, you triggered another thought. So you're suggesting we establish a paper trail.
Just a little, a thank you or something. Just anything.
Right. A piece of paper. It says.
So there's a little evidence that
Uncle Tony sent me money.
Thank you.
Okay.
You need my address?
Yeah, in case I send you. That's the other. Can I send this money to anybody, or does it have to be a family member?
$19,000 per year per person. And the thing is that if you and your wife decide to give one of the kids, your wife says, "I don't want to give it to you." You give them. You could give $38,000 to your son.
Yeah.
It counts as a joint gift. She has to sign off on it, but you could give $38,000 to one of the kids.
Okay, so it can be you and your spouse combine it to one person.
And then if your son is married, you can double that.
Wow.
So you can do a joint gift from you as a joint donor, and so you can transfer quite a bit of money if you need to.
Right, and you can do this yearly?
Every year.
Once a year. Nice to know.
Yep.
I hope I have that problem.
Yeah.
All right, so you brought up, that money comes off my estate.
Yep.
Okay, and you just said estate taxes are different in the federal government versus Massachusetts or any state you live in, or they?
The exemption's different. Yes, it's different in every state. The federal is the federal.
Yeah,
it's $15 million, so you don't have to file a federal estate tax return unless you are over the $15 million. In Massachusetts, you actually have to calculate the federal return to figure the state taxes. They make it very, very difficult in Massachusetts. So, but it's $2 million exemption. So if your estate is under $2 million, you don't have to worry about it. The attorneys file some paperwork in Boston just to clear the title on the house and the car and things like that. But for the most part, you don't have to worry about estate taxes. But maybe the last year, you still have a personal tax return to file.
How about things like long-term care and that kind of stuff? I'm thinking about retiring, I'm hearing about how much long-term care costs in terms of an insurance cost. If I buy that, is that tax deductible?
So, first of all, again, that's an individual thing, whether you think you need long-term care insurance. Because obviously, nursing home costs can be $150,000 a year without batting an eyelash. You go through your estate pretty quickly. If you have the insurance, financial plan, or estate attorneys and trust attorneys can set up a plan. So you have the insurance, it pays for a certain amount of time.
Right.
Then when you first go in the nursing home, you put everything into the trust. The insurance pays for the waiting period. Then all your assets are scot-free from the nursing home. So again, that's long, that's planning. But as far as your original question, yes, it's deductible on the federal return. Under a medical expense, most people don't have enough medical costs to get a deduction, and then they don't have enough itemized deduction to itemize. So yes, it could be deductible, but
reality says it's probably not.
Reality, not a lot of people are hitting it.
Right, right. How about things like, you know, like I have a beach property and I'm going to retire.
Yep.
I don't know if I'm going to keep going to the Cape.
Yep.
If I sell that property, how much taxes? How does that implicate my taxes?
Yeah, well, that'd be a big windfall for you.
Yes, I hope.
But it also is fully taxable as capital gains in most cases. Something to consider is you do have the residential exemption.
Yeah.
So you have your home up here.
Right.
You sell that home. You've been living there and owning it for 2 out of 5 years.
Yeah.
So you get your exemption of $250,000 for an individual, $500,000 for a married couple. So if your profit's less than that, you pay no taxes.
On my beach house?
Oh, no, on your personal residence. Now you move down the Cape for 2 years.
Oh, okay.
So you stay down there for 2 years. You can actually do the same thing again as long as it wasn't a rental property. So if it was just a second home, you know, and some people kind of jump the gun on it a little bit. You've been living in your house for 20 years.
Yeah.
I'm going to change my residency for the house down the Cape now.
Right.
I'm going to sell my house up here next year.
Yeah.
But again, it's 2 out of 5 years, so you can move down the Cape for a couple of years and maybe save some taxes and live there.
Wow.
But you have to actually establish residency.
Yeah.
Voting down there, your license, everything else. Just like moving to New Hampshire or Florida to avoid the state taxes.
That's nice to know.
Yeah.
So if you own property, rather than just sell that property outright, which is what I would have thought would have made sense, don't do that.
No, well, again, talk to someone, but it can't be rental property. That's taxed differently.
Right.
So.
I couldn't have used it as rental property, you mean, in the past?
There's calculations and things.
Of course
you have
there
to,
is.
Of course there is. You know.
But if it was just my property and I just went there during 3 months for the summer, and that would be
second home.
Yeah, second home. So
it used to be where you could get away with that, and they changed that.
Yeah, they changed that law.
Oh, probably 10, 12, 15 years ago. So.
Right. But that, I mean, again, that's something that I had not considered. I didn't even know about that.
Talk to someone that does this for a living.
Yeah.
Or you know, in a lot of cases with the senior centers, I know a lot of them will have someone come in during tax season and set up and give some of the seniors tax advice, and that's always a great route to go. They don't charge for it, and I don't believe any of them charge for it, but it's an opportunity for them to get some questions answered.
To get some questions answered, yeah. That's an excellent idea. So other than going to a senior center and getting tax advice, if I wanted to get my own tax accountant, where should I go? Who should I look for? What kind of qualifications or degrees or certifications should I look for?
Well, obviously CPAs have gone through a brutal exam, at least back when I took it 100 years ago. But it's still, they need training and everything else now. They need hours in a different firm. So you want to seek out a CPA. There are enrolled agents that are very good at doing taxes. Enrolled agents are just licensed with the IRS.
Okay.
You know, so they're not doing other accounting or other work like that. But you know, seek out a CPA. Get a reference from friends or someone that are out there. It's getting more and more difficult. A lot of the one-man operations like myself are going away.
Yeah.
So they either have a choice of going to the big firms. The H&R blocks always fill the gap. So that's an opportunity. If you don't have a real complicated return, you go to someone like that. Usually they're pretty reputable. They go through some training, not a ton, but they do go through some training, and they're always checking the work that their preparers are doing. So, but Joe Blow in the corner,
Yeah.
you know, that just hangs a shield 4 months a year and closes down, you know, Joe's Tax Service.
Yeah.
I just kind of stay away from that a little bit. But, you know, I'm sure some of them are doing a real good job. But I would stick with, you know, the local CPAs if you can find one.
Okay. Yeah, it's good advice. And there are a lot of them. I mean, I drive around and I see
There's a lot of them,
signs.
but they're fewer and farther between. You know,
As a
it's
sole
get-
practitioner, they
yeah,
tend to be
yeah,
in a large firm.
the 2 and 3 person operation
Operation,
like
yeah.
I was, it's just there's few of them around.
Wow.
And a lot of the firms don't want to do more tax work. They have plenty.
Yeah.
They're not taking on new clients.
New clients
so,
to boot.
yeah. So just
Yeah.
try to get some references and
And I probably should do all of this before I retire.
do it before you retire, before January. You don't want to be doing it in January.
Right,
so
right.
any good preparers going to want to take a look at your last year's
Yeah.
return and everything. And once January hits, it's gets a little busy.
Yeah, I'm sure. One other question that comes up, how about things like Medicare?
Yep.
And how does that affect my taxes, or does it?
Well, it's the amount you pay for Medicare is based on your income. Most people pay just over $200 a month for Medicare. But if your income spikes up because you had a big sale or a big windfall or
Oh, yeah.
something from work, it can go up to $700 a month.
A month?
You know, if you're making over, you know, if you
Yeah.
made over $500,000 in the 1 year, it can go up, and it's tiered until you get to that point. If you had a one-time windfall, you can appeal it
Yeah.
to Social Security. Sometimes you win, sometimes you lose. But
Like the example of selling my property.
yep,
That would be a one-time windfall.
big
that
windfall.
Yep.
You try to appeal that. Again, same circumstances, you may get different answers. It's not black and white.
But it's going to go up, and does it stay up? I mean,
No,
what happened?
The next year it will come down.
Oh, it'll go back
There's
down to what it was?
Right. There's a year or two delay in it increasing, but then it goes right back down
Yeah.
with the next year's
Yeah.
tax return, because they base it based on your tax return.
They base it on your tax return.
Right. They get notified from the IRS.
Right.
Here's the income. Jack up his Medicare.
Wow.
Yeah. It's something that not a lot of people plan for when they have a sale.
And this one-time bump could be anything. It wouldn't be
Right.
property.
No.
It could be
No.
it could be stock that I owned
That's
that
correct.
I became vested,
Yep.
and all of a sudden I had to sell it because I
Yep.
was retired.
Yep.
So that would hurt me like in the first or second year.
Right.
Whoa,
So keep that in mind when you're doing it.
when you're doing
But
it.
again, some planning
Yeah.
can sometimes avoid that.
Minimize it at least. We'll try to minimize it.
Yeah, avoid other income that year. You know,
Yeah.
knock the income down if you can.
All right. Did I miss any important things that you've seen in your practice? I mean, the questions I had, mostly the
Yeah,
questions I have and friends have asked me
Just
about.
the big differences between the state and the federal tax return. So the federal tax return, you can make over $30,000 as a married couple over 65 years old and not have to worry about taxes, so you can make substantial money. You can have capital gains that go up to $90,000 if your income is very low and not have to pay any capital gains taxes. The state is a little different. Their threshold is $8,000 and want you to file a return. There may be some deductions that you can take, so you still don't have to pay taxes, but you have to file a return. You know, they have the circuit breaker. Very important for a lot of the seniors. If your real estate taxes and 50% of your water and sewer bill are more than 10% of your income, then you get the circuit breaker credit. And a
Okay.
lot of seniors are qualifying for it. I think the biggest issue is they have to come to someone like myself to file a tax return to get this circuit breaker money back. Even though they're not required to file, to get the circuit breaker credit, refundable credit, they have to file. So I wish the state would come up with something a little different to allow them to do it without coming to a preparer to get it done. But that's $2,800 credit that they could receive. You know, there's a couple other small deductions the state has. You know, if you get the rental deduction, you could save a couple $100 on your taxes. Sounds like a big deal. You know, you get half of your rental as a deduction. And then, you know, the commuter the MBTA
Yeah.
pass or the Easy Pass that you have, again, if you max out on that at $750, the credit is $30 in your
Yeah.
pocket. So they have a few things in the state. State's kind of a confusing tax return. Massachusetts is kind of I guess it's confusing for people out of state. It's confusing for people in the state. Not as bad as Pennsylvania and New York and California. They're kind of the worst, but it's not as easy
Yeah.
as something, at least like Rhode Island has like 4 lines or
Yeah.
something. So
what I think I heard you say is, like, for federal taxes, if I make less than 30,000 was
Yeah.
the number, I don't have to file a federal return?
no. You may want to file because you had some withholdings and you need to get that money back.
Okay.
That's the only way you're
Right.
going to get the money back.
Right. But
And-
legally, I wouldn't have to
Right.
file necessarily.
because there's no taxable income. So
But that's
they're
not true
exempt.
for Massachusetts.
That's not true for Massachusetts.
So my state, even though I may not file a federal one, I would have to file a state
Keep
one.
in mind, you still have to
And-
file a state
and
tax.
You said 8,000?
8,000 is the threshold for Massachusetts.
Right.
yeah.
So if I make more than $8,000 a year, yeah. Wow.
So keep that in mind.
Okay. So I always have to file a state no matter what.
And that's the complicated one.
And that's the complicated one. Anything else you want to talk about?
No, I mean, just do a little prep work. Try to utilize your resources. Get in the senior center, see if they have someone coming in to give some tax advice. If you have a big event coming, talk to a professional that's
Yeah.
out there. It's maybe worth your while and talk to them before, don't talk to them
Yeah.
after.
Yeah, right.
It gets a little difficult to fix things, when someone comes in and says, oh, by the way, I sold all my stock in this company that I was working
Yeah.
for years, and I have a windfall of $100,000.
Yeah.
Now what? It's like,
Yeah.
well, you should have told me 6 months ago when you
Yeah.
sold this, and we would have done a little bit of planning.
Is there any way to spread that out?
Well, yeah, you can sell it over a different period of time. You need to have some withholdings, so
Okay.
you don't have to pay penalties to the IRS or the state. So those are things to keep in mind. But every situation is different. Every
Yeah.
individual is different, and now the rules are getting more and more complicated because they go up and down on a regular basis.
So to wrap up, what I think I heard is that I probably need help. This sounds like it could be complicated. If I can't afford help, I could probably get help at the senior centers,
Correct.
right? And if I go to seek help, I should probably look for a CPA.
Or at least an enrolled agent.
Yeah, at
Someone
least.
who has some background in preparing tax returns.
As we wrap up, I hope today's conversation with Art gave you a few things to think about concerning your financial situation before you retire. But here's the truth. Retirement doesn't just happen overnight. It really unfolds over time. One decision, one conversation, one step at a time. And when you take a moment to slow down and think it through, you can move forward feeling a whole lot more confident. Now, my co-host, Sue Roback, and I are really looking forward to continuing these conversations with you in future episodes of the Aging Agenda and Aging Boldfully shows. We'll keep bringing you practical ideas, real life experiences, and honest conversations, the kind that help you make sense of where you are and where you want to go next. You can think of the Aging Agenda show and our companion program, the Aging Boldfully show, as your personal retirement concierge. We're here to help you figure out what's next, because the best years might still be ahead of you. You can find both shows on YouTube. Just search Aging Agenda or Aging Boldfully. Thank you so much for spending time with us. We really appreciate it. And I want to thank Arthur Vigeant today for being my guest. I'm Tony Da Silva, and on behalf of Sue Roback, this has been the Aging Agenda show, helping you plan your next chapter clearly, confidently, in your own terms. We'll see you next time.
This program was made possible by your Franklin friends and neighbors, good folks just like you. Thanks for supporting Franklin TV. And thanks for watching.